Before we begin, just let's make sure that everything is working, and please type pluses or press a fire icon on the screen so that we make sure that you can hear and see me. If you do, okay, yeah, very good. Everything seems to be working, and let's start. First of all, yes, my name is Viktor Kalgin, and I'm a tax partner at KEPT, which is a former KPMG Russia, and I help clients to structure and maintain tax efficiency of their international businesses with assets in various countries, primarily with Russian origins, but in other countries as well. And I help restructuring, and this is what my team and I have been doing for a long time, for years, and we advise clients on how to structure businesses, international businesses, in a tax efficient manner. And I welcome you to this event, which is a webinar on tax changes that affect international structures. And we selected 15 items, 15 most important topics which affect structures of our clients. And I decided we prepared on each of these 15 topics an overview and practical implication of these changes. And the name of the event is speaking for itself. It's how to maintain tax efficiency of international structures in 2024. Okay, in a few minutes I will tell about the contents of this event, but first of all, a couple of administrative matters. The most common question which we are being asked is whether the materials, the recording and the slides of this of our events webinars are going to be circulated, and the answer is yes. So you will receive in a few days. It takes time to prepare, to make everything ready for circulation, but the recording and the slides of this webinar will be circulated among the participants. So you will receive slides and slides and recording. This one thing. Second, I'm not going to be alone, and there is another speaker, a colleague of mine, Ksenia Shugalko. She will appear closer to the end of the webinar, and you will, she will address a couple of sections, a couple of changes, a couple of items of the agenda. That's the second one. Yeah, and we received numerous questions before the webinar, and I'm going to address some of them, and we took them into account when preparing the contents of the webinar. But you're also encouraged to ask questions as we go, and there is a question tab on the screen. You should see it, and you can type in questions there. And at the end of the webinar, we'll have a Q&A section where I will respond to the questions which we are receiving, which we will be receiving during the event. So this is the plan. I think this is it on the administrative side, and we can move on to the contents. The webinar is going to take place. It's going to last for 2.5 hours. It's going to be dense in contents, and the contents will be split into several sections. The first one will be about Russian changes that affect international structures, and we will talk about suspension of tax treaties, about case law on withholding tax and other cross-border issues in Russia, cross-border transactions. There we will look at most recent practical cases and case law disputes between taxpayers and tax authorities on withholding tax and other cross-border transactions, other cross-border matters. We will talk about a very significant development, which I think largely remained unnoticed, or doesn't receive enough attention, is introduction of withholding tax on services in Russia, which is a major change, I think, and I see more and more questions that are being asked about this development. Also, we'll talk about dividends in non-arm's length transactions. So in case a transaction between a Russian company and its non-Russian related party is not at arm's length, in some cases they will be, apart from the transfer pricing adjustments to which everyone is more or less accustomed, there will be deemed dividend or imputed dividends on the difference between market price and the actual price in some cases. We'll talk about this. Next, Russia updated blacklists of countries. We will talk about implications of this of these changes for international structures. And finally, in the Russian section, we will talk about tax developments that affect personal assets and personal structures. We picked out 3 of such changes. Next, we will continue and discuss changes in Kazakhstan. I see more and more interest among our clients and among international companies to this country, and its tax rules and practice are constantly changing as well. And we'll talk about three major developments that I see that affects many investment structures with assets in Kazakhstan. The first one is the limits on deductibility of intra-group services, and the 3% limit, which was introduced more than a year ago for 2023, was abolished. Not completely, but it was narrowed down quite significantly. We will continue and discuss cross-border case law in Kazakhstan, and most important trends over the year or so that affect international structure with investments in Kazakhstan. And we will talk about tax incentives for Astana International Financial Center and Astana Hub. We'll see how these tax incentives provided to investors there are being changed and how they develop. Next, we will continue and talk about United Arab Emirates. As you know, as you probably know, there is a tax reform which is going on, and last year a corporate tax rate of 9% was introduced, which is a new development. Everyone is kind of used to using the United Arab Emirates as a tax-free country. Well, not anymore. And so we'll talk about, but still, the 0% corporate tax rate is still achievable, and we'll talk about the new lists of qualifying activities and qualifying income, which emerged a couple of months ago, maybe more, 3 months ago, in October and November last year. And we'll discuss opportunities to restructure assets and moving assets from other countries to the United Arab Emirates, and we see more and more interest to, for example, redomiciling companies to the UAE, and we'll talk about this. Next, a couple of things to talk about in the European Union and the developments there that affect cross-border structures, especially with Russian assets. And about a year ago, in February last year, the European Union included Russia into its blacklist of countries. We'll consider examples with Cyprus and the Netherlands, how this affected international structures. And another topic will be about, well, again, about personal structures and beneficial tax regimes for individuals. And we'll talk about developments in Portugal and broadly about, well, opportunities to structure personal taxes in other countries. So it will be a reason, well, phasing out of the NHR regime in Portugal will be a reason for us to discuss broadly what tax regimes are available for individuals in other countries. Hong Kong, and there a colleague of mine, Ksenia Shugalko, will step in and discuss changes in Hong Kong, especially exemption of income and developments in this respect. And we'll finish by talking about the global tax reform and Pillar 2, which will be addressed by Ksenia as well. So this is the plan. As you can see, the agenda is quite dense, I would say. This is why probably we should not spend any more time and move on to the first part. The first part is Russian changes and suspension of tax treaties. Well, first of all, to give a bit of a context to this discussion, Russia still has more than 80 double tax treaties, which are, well, important, for important asset for the country as a whole and for investors, because they allow to reduce tax burden on cross-border transactions. They provide various tax benefits, but the most common type of benefit is reduced withholding tax rates on payments from Russia to other countries. So in case if Russia has a treaty with another country, then so-called passive income may be subject to reduced withholding tax rate, because Russia may, for example, as is seen on the slides, for dividends, Russia imposes withholding tax at a rate of 15%, and some treaties, many treaties, in fact, reduce these withholding tax rates to 5%. Not all of them, it depends on the treaty, but it's not uncommon to see a Russian double tax treaty with another country where 5% rate is achievable for dividends. Interest and royalties, there the decrease is even more substantial, from 20%, which is a domestic rate that Russia imposes, to as low as 0 exemption, again, depending on the treaty. So what happens last year in August? Russia suspended 38 double tax treaties, including all European Union countries, the United States, Great Britain, Japan, Switzerland, Singapore, and more. Australia, New Zealand, yeah, there are many treaties which have been suspended. 38 is almost half of Russia's treaty, treaties. Notably, a number of treaties which are useful for structuring international businesses are still in place, has not been suspended, which includes Hong Kong, for example, and Kazakhstan, as well as other countries in Asia, for example. So what does it mean in practice? What practical implications are? It means that if, as is seen on this slide, if a Russian company pays income which is subject to withholding tax in Russia to a foreign country, then if the foreign company is located in a country with which Russia has suspended the double tax treaty, then the reduced withholding tax rate is not achievable, and withholding tax is going to apply at a full domestic rate for types of income such as, well, as I said, dividends, interest, and royalties, but not limited to these 3 most common types of passive income. Also, income from international shipping is going to be affected, income from lease of equipment, capital gains in case directly or indirectly movable property in Russia is sold, and other types of income from Russian sources which Russia considers subject to withholding tax. And Russia's source income list is open, and yeah, there may be any other types of income which are subject to withholding tax. Strictly speaking, not subject to withholding tax, at least, explicitly stated in the Russian tax code that acquisition of goods is not subject to withholding tax. There used to be services and work included in the non-subject to withholding tax list, but it changed, and this is another reason why suspension of double tax treaties is so important, because from starting this year, services provided by Russian related parties to their services provided by foreign companies to their Russian related parties are going to be subject to withholding tax in Russia, and if a treaty is suspended, then no relief is granted. We'll talk a bit later about this. But there is some good news. There are temporary rules that were introduced after the suspension took place that allowed to continue using reduced tax rate benefits to some types of income. And we will talk about these temporary rules. Well, how the situation developed. After the suspension took place in early in August last year, almost immediately, the Russian Minister of Finance said that tax treaty benefits can still apply to interest on bank loans, which was important, I think, for the business community. It provided some certainty, some relief that bank interest can still be subject to reduced withholding tax rates, even though tax treaties were suspended. And the ministry announced legislation changes to the tax law, and they took place indeed. A few months later, a law was adopted that allowed applying tax treaty benefits despite the suspension of the tax treaty until the end of 2025 for, strictly speaking, for seven types of income. Seven types of income. First of all, as was promised, interest paid to banks and credit agencies. What else? Lease income from aircraft registered in Russia under contracts concluded before the 5th of March 2022. Okay, so lease income from aircraft under certain conditions. Royalties for audio and visual contents and other intellectual property broadcasted on television. And also royalties, or well, income from the right to use of objects protected by copyright, including software, firms, patents, and know-how, etc., and some other things. I think this type of income, at least in my in my experience, is most commonly used because Russian companies pay licenses for software, and all of a sudden this income became subject to 20% withholding tax rate if it's paid to a country with which the double tax treaty is suspended. But luckily, this was included into the temporary rules. This type of income was included into the temporary rules. What else? A few more. Capital gains from sea vessels, which are registered and located in Russia. Income from international shipping in certain conditions, under certain circumstances, and income from lease and sublease of sea vessels. Okay, this is the list of seven types of income. And what does it mean in practice? Important limitations. First of all, the companies that can benefit from the foreign companies that can benefit from these temporary rules should not be related to Russian parties that pay this income. So it's not for intra-group payments. It's only to not related to transactions between unrelated parties. This is one thing. And the other thing is that, well, as the name suggests, the temporary rules only apply for a certain period of time, for a couple of years, until the end of 2025. But okay, 2 years is enough to take action, and yeah, this is what we generally recommend to do. But while the rules are applicable, how it's going to work? If a foreign company receives income from Russia and the payment falls under the type of income that's subject to the temporary rules, then the foreign company will need to make sure that the company is not related to the Russian payer, or the Russian company, and yeah, it is in a country with which Russia suspended the double tax treaty, which is also important. The temporary rules, the reduced rates only work if it's in offshore states where there hasn't been a double tax treaty. Then the rules, the reduced rates do not apply. And the remaining, the remaining part of the process is to obtain tax residence certificates and confirm that the foreign company is the beneficial owner of income, and that gives a basis for reducing the withholding tax rates or even exempting the income completely from withholding tax, depending on the treaty conditions. But questions remain. First of all, it may not be easy to obtain a tax residence certificate from a company that receives income from Russia, because we see in practice more and more instances where tax residence certificates for Russian sourced income are not issued by foreign states. Next, there was a period when the treaties were suspended, but the law with temporary rules, the temporary exemptions, was not adopted between August and the end of November. Strictly speaking, taxpayers should have withheld tax on these types of income, which were subsequently became subject to the temporary rules. And the practical question is what to do in these cases. And I think the obvious answer is to, because the law it extends to, it basically applies retroactively. It extends to the beginning of the period when the treaties were suspended. This is why refund of taxes makes perfect sense. And if in any case, if withholding tax was not or couldn't be refunds, or the exemption is not, or reduced rate is not available, whether it is possible to credit this withholding tax in other countries. And this is a general rule where withholding tax can be credited generally. Depends on the situation. We'll talk a little bit later more about this. But in general, it should be possible in many instances to credit withholding tax paid in one country against income tax paid on the income in the other country where the recipient of this income is located. It can be done either based on double tax treaty or based on domestic law. It depends on the particular situation. Some countries, they have domestic law provisions that allow crediting withholding tax against local income tax. In other cases, a treaty needs to be in place because treaties usually allow crediting withholding tax in one country against income tax in the other country. But obviously, it will depend whether the credit is available will depend on how other countries respond. And we see different developments here. There are countries that denounced or cancelled double tax treaties with Russia. Ukraine and Denmark are the examples. Some countries declared that they suspend tax treaties, and Austria and the Czech Republic are notable examples. Latvia was one of the first countries to suspend the tax treaty with Russia, but subsequently the treaty was cancelled, denounced, and it's not in place any longer. But some countries explicitly stated, at least some time ago, officially stated that they continue applying, or from their comments, from their official response, it was evident that they decided to continue to apply their treaties with Russia. This includes Germany, Switzerland, Cyprus, Great Britain, and Hungary. Again, situation may change, and it's constantly developing. Countries may change their position, and ultimately the treaties can either be suspended or cancelled by the other countries. But yeah, there are some examples, and there are reasons for that. Strictly speaking, suspension may not. It's not a mechanism that is provided by the treaty itself. Treaty can either be effective or denounced or cancelled, but intermediate states where it is suspended is not, strictly speaking, in line with the treaty's provision, usually. Okay, so this is where we are. And again, if the treaty is in place, most likely in the other country, if the other country continues to apply it, it may be possible to credit withholding tax, which is paid in Russia. But again, it will depend on many factors, on the country's position, on its domestic law, and also on its on the implications of Russia being included in the blacklist of countries by the European Union. And we'll talk about this later. But yeah, inclusion of a country into a blacklist may imply that withholding tax credit is not available in a European country. Okay, but there is good news. There are new treaties emerging, and one notable example is Oman. The double tax treaty with Oman, between Oman and Russia, came into force and became effective starting this year. It's not necessarily the most important development, because many businesses, they kind of await until the tax treaty with the United Arab Emirates is negotiated and put in place. And we'll talk about this on the next slide. But it's an interesting example because it demonstrates how Russia, what approaches and what rates Russia tends to negotiate and put in place with other countries. As currently it is a policy to try to negotiate so-called 10-10-10 rule, where interest, dividends, and royalties are subject to withholding tax at a rate of 10%, which is not the lowest rates possible. And we see more beneficial treaties, but the new trend, the new approach that Russia takes to other treaties is to apply 10% withholding tax rate. And we see this happens with the treaty with Oman. So for dividends, there are conditions for the 10% rates. For interest and royalties, 10% rates is applicable without special special additional criteria. Yeah, taxation of capital gains from indirect sale of immovable property. So this treaty with Oman is very similar, and there are no surprises here. But most businesses really wait for a double tax treaty with the United Arab Emirates to be concluded. And here some news emerged last week that yeah, you may know that Russia has been negotiating a double tax treaty with United Arab Emirates for well, since at least mid 2023. So more almost, yeah, I think it's almost a year that Russia has been negotiating a new treaty with the United Arab Emirates. But the news emerged that Russia's proposition to have these 10% rates for dividends, royalties, and interest was opposed by the United Arab Emirates, because they argue that other Gulf countries such as Qatar and Saudi Arabia, they have more favorable double tax treaties, and this is why the UAE proposed either to use more favorable conditions or to renegotiate treaties with other Gulf countries. And this is the news from the Russian newspaper Kommersant, where it is said that, yeah, Russia has proposed Qatar and Saudi Arabia to renegotiate double tax treaties, probably in order to increase withholding tax rates there, so they are not benchmarked. They're not used as a reference for concluding a double tax treaty with the UAE. We'll see. Many hope that this year the treaty will be signed, but as it seems, it will depend on developments of negotiations with other countries, and it will not be surprising if we do not see the treaty with UAE signed this year. But yeah, it is what it is. We'll have to wait and see. So what to conclude from this, well, substantial development that Russia suspended double tax treaties with other countries, what can be recommended? First of all, there are solutions that can be used to maintain tax efficiency of international structures, and it can be considered to use a so-called look-through approach, where an intermediary is not taken into account for withholding tax purposes, and the beneficial owner, which is somewhere else, and hopefully in a country where the double tax treaty is still in place and is not suspended, is found, and this is used as a basis to apply tax treaty benefits. Yeah, there are other solutions, but yeah, this is one which most obvious and should be tested. Yeah, there are temporary rules. Let's not forget about them, and it's important to test whether a particular transaction falls under one of these types of income which are temporarily exempt of subject to reduced withholding tax rate. Yeah, the most common and visible trend is to move to so-called friendly states, and Cyprus and Netherlands and other countries which we had seen in structures with Russian assets. They are being replaced notably by the United Arab Emirates, which is why a double tax treaty with this country is so important for Russian businesses. But also Hong Kong and Kazakhstan are commonly seen in different countries in different situations. But yeah, move of structures from states where double tax treaties are not longer effective, or yeah, there are other difficulties to conduct business, is a visible trend. And finally, we also see that foreign structures, non-Russian structures, are being moved to Russia. So this is the fourth consideration to completely shift businesses from international, from presence in other countries into Russia. And it's sometimes possible to replace non-Russian entities without losing too much, and maintain tax efficiency. For example, over the years, we have seen trends to put assets into unitary investment funds in Russia, which are tax-free vehicles essentially, and they provide tax benefits which are sometimes even not achievable by other countries and using other structures. Okay, so this is where we are, and what can be done. The next, let's move on to the next topic: case law on withholding tax and other cross-border situations. We see three main trends which we are going to discuss. First of all, more and more withholding tax claims. It is an obvious trend. Next, requalification of restructuring transactions. This is another trend, and tax claims in financing structures. So we'll look at case law in all these three areas, all these three trends. And let's start from the first one, from the withholding tax. Here on the slide, there is a diagram with Russian company, which belonged to a French ultimate parent company, but the structure was, it is not uncommon to see investments through Cypriot companies into Russian assets. And that was the case with in this situation, where the French parent company had an intermediary holding company in Cyprus, which ultimately, well, not any longer, it's not that efficient and even practical to use EU countries for investments. But this case has a broader significance than to demonstrate how Cyprus may work or may not work in such structures. So what happens? Basically, the Russian company distributed dividends, and it was clear already at the time in 2016, 2018, when dividends were distributed, that it's very difficult to claim treaty benefits under the Russia-Cyprus Treaty for intermediary holding company. It is likely that it didn't have much substance. It didn't really have employees. Whatever is necessary to demonstrate that the company is the beneficial owner of dividends was not in place. This is why, from the very beginning, a tax treaty between Russia and France, the ultimate parent company, was located in France, was claimed, and this treaty allows for 5% withholding tax on dividends. But the tax inspectorate didn't agree, and the reason mainly was because the double tax treaty between Russia and France, and it is still the case in many other tax treaties, including the new treaty with Oman, where it is necessary that the company that claims the lowest achievable withholding tax rate, 10% in case of Oman and 5% in case of France, it should either have investments into the Russian subsidiary or should have a share in the Russian subsidiary. And both criteria, both conditions are interpreted formally by the Russian tax authorities, and there are reasons based on the wording of most treaties that formal interpretation means that there should be a direct investment, or direct participation of the beneficial owner of dividend in the Russian company that distributes dividends. And that was the main reason for the Russian tax authorities to dispute the reduced withholding tax rate and charge 10%, which is still lower than the domestic rate of 15%, but 10% is not as good as 5%, obviously. And again, the reason was that to enjoy the 5% rates, the French company should have fulfilled the investment conditions, should have invested like 500 French francs. At the time it wasn't even euro, but it's an insignificant amount. But the formal interpretation leads to a conclusion that intermediate holding prevents the French company from applying the reduced withholding tax rates, the most beneficial tax rate. The reduced withholding tax rate was still available, but one of the conditions was not met. This is why the 5% rate was disputed, was challenged by the tax authorities. Yeah, there were other insufficiencies in the structure, but the key problem was that the participation was not direct. And the judges resolved the case in favor of the tax authorities, so it was negative for the taxpayer. And what can it teach us? Well, basically, the main conclusion is that investment through intermediary structures may not work in terms of withholding tax for dividends. Again, situations vary, but as the most as the most likely outcome is that the minimal withholding tax rate will not be achievable. There are exceptions. For example, the Russian treaty with Kazakhstan, it provides for the 10% withholding tax rate on dividends regardless of any condition. Yeah, there should be, the company claiming the treaty benefit should be the beneficial owner of this dividend, but apart from that, there is no requirement to invest or hold specific participation for any length of time in the company that pays dividends, which means that in some cases you can apply. You can look through the intermediary holding structure, holding company, and apply the minimum achievable rate. Although it's very uncommon to see the 5%, which is the best rate for dividends, achievable without any additional conditions. I can only recall one treaty with Qatar. It's interesting that there is no other additional requirement for the 5% withholding tax rate for dividends, but it's an exception. What can be done? Well, apart from direct participation and avoiding intermediary holding companies, it can be considered to hold a minority share directly. If you need an intermediary holding company, you can still fulfill either the investment criteria or the participation criteria by investing some portion of assets of holding some share directly. Again, it's not ideal because there are instances where even such structures were disputed, but it's something to consider. There was a problem in this particular case that it was not obvious that dividends ultimately reached the top holding company, and so to avoid any doubt that to be the beneficial owner, the key and the most obvious indicator is that the company received income, received money from the Russian sourced, from the Russian source. In this case, it was not obvious, but sometimes it can even be, as simple as paying the income directly to the ultimate recipients of income, and then performing some additional restructuring steps, and just drafting simple documents that will legally make the situation, as it should be, where intermediary legally receives income, but it's remitted directly to the ultimate, to the beneficial owner. Okay, those are not ideal solutions, but something to consider to avoid withholding taxes, reduce withholding taxes to be disputed. Next case, where we also see withholding tax claim, is the Mir Business Bank case, where there was a subsidiary of, interestingly enough, of an Iranian bank in Russia, where what happens, basically, the Russian company, it's converted its retained earnings into capital, into its paid-in capital. And no actual payment was made, so there was no distribution, but the mere conversion itself was treated by the Russian tax authorities as dividends subject to withholding tax. And despite no payment, even no offsets, nothing was received by the foreign parent, the tax was imputed. Well, the somewhat good news is that the reduced rates, the reduced withholding tax rate was applied based on the treaty between Russia and Iran, but otherwise, I think it was not expected by the Russian company that in the absence of payments abroad, withholding tax is claimed. Although there has been clarifications for a few years already, it was known that conversion of retained earnings into capital is considered as income of the foreign parent company, and it may be subject to withholding tax. And that was the case in this particular situation. Okay, again, it's interesting that after we prepared materials for this webinar, the Russian Supreme Court decided to revisit the case. It's not yet clear what is going to happen, but the wording, how the case was, brought to attention of the Supreme Court, suggests that there may be positive developments and there may be positive outcome and different outcome for the taxpayer. But for the time being, it's unclear, and the outcome for the time being is negative. And what else? The position of the Russian Minister of Finance and the Russian tax authorities is clear that conversion of retained earnings into capital should be subject to withholding tax. What could be done differently? It's hard to tell. Most likely, there were reasons to convert retained earnings into equity, into capital. But if withholding tax is unavoidable, it may make sense to distribute dividends and then pay them back. At least it may increase the cost basis of shares for the Russian company in the Russian company. Again, it will depend on whether the cost basis is required and whether actual payment is practical. But it doesn't improve the situation with the withholding tax, because withholding tax is going to be due anyway. Although the Russian tax authorities in some cases may not be as generous as in this case, and may not apply the reduced withholding tax rate, and they may apply the basic, the domestic tax rate. While if you do it yourself, you can collect the necessary documents and make sure that the reduced withholding tax rate is applied. But yeah, this is something to consider, is to distribute dividends, actually distribute dividends and then contribute them back. At least it doesn't improve the situation with withholding tax, but it may improve the situation with the cost basis, which may require later on if the subsidiary is sold, for example, especially if it's property rich, or if it's not subject to participation exemption in the country where the parent company is located. While dividends may be exempt, and there are instances, there are tax systems in the world that indeed have this difference. Okay, let's move on. A few cases which we are not going to discuss in much detail, but which we can consider briefly and take into account, because they also about withholding taxes. Mostly last year's cases. There is a case where a Singaporean company received interest income from Russia, and withholding tax exemption, or I think, yeah, it should be exemption with Singapore, was claimed, but the Russian tax authorities disputed and successfully disputed the reduced withholding tax rate, claiming that Singaporean company was actually an intermediary and agent, and was not the beneficial owner of this dividends, of this interest. And yeah, they successfully demonstrated that the actual beneficial owner which booked this income, which received it ultimately, was a company registered in Cayman Islands, which is obviously an offshore state where no double tax treaty with Russia is in place. So this negative outcome was more or less obvious. Another case where there was import of goods into Russia, and the tax authorities they proved that the acquisition price was not arm's length, and the difference, the non-arm's length amount, the difference was not only denied for deduction in Russia, but also was subject to withholding tax. And despite at the time there was a double tax treaty in place between Russia and Cyprus, which still is, but suspended. Despite the existing double tax treaty, withholding tax was successfully charged by the Russian tax authorities, and they won the case in court, which means that non-arm's length transactions, even without imputed dividends, which we are going to talk about later, already contains withholding tax risks. Yeah, and the bottom line, the conclusion here is that one should not expect that inflated acquisition price for whatever is paid from Russia abroad is only going to be denied for deduction. It can also be requalified into passive income, and additionally, withholding tax may be charged, as evidenced by the Profam case. Okay, next one is where again goods were acquired. There was payments in installments, which meant that some parts of the payments was in fact interest. And I think, as is alluded to in the decision, it was separately stated in the contract, in the document, that some price for some acquisition price was interest for delayed payments. And since the seller was in a country where interest was subject to withholding tax under a treaty with the country, namely Belgium, the Russian tax authorities successfully charged 10% withholding tax rates. Again, I think this conclusion is fair. indeed, if there are interest payments, some parts of consideration is in fact interest, then it should be subject to withholding tax unless tax treaty benefits apply, which was the case here, but it was not exemption. This is why 10% instead of 20%, which is the domestic rate, was claimed. Another case where there was a debt of loan of a Russian company borrowed from its Cypriot lender. Some interest was accumulated, and the company decided then to novate this loan. I think there was a promissory note issued in exchange for this loan. Or yeah, in one way or another, the obligation was kind of updated or novated, and this accumulated interest became immediately subject to withholding tax, which again I think it's fair. It's not necessary to pay. Actually, the debt may be changed or offset against some other obligations, which triggers withholding tax implications, which was the case here. And not only that, but also the fact that the Cypriot company, Cypriot lender, was not the beneficial owner of interest, was the reason for the withholding tax charge. And again, this case demonstrates that, first of all, not even cash transactions or offset, but changes with the obligation can trigger withholding tax implications. And yeah, again, attention should be paid to beneficial ownership confirmation. Okay, let's move on. And the next example, next trend in cross-border transactions is case law where these transactions are requalified for tax purposes. And this example, the White Square case, or the company is called Quartal 674, 675, but I think the White Square name is more kind of sounds better. But anyway, in this case, and we'll see it on the next slide, basically what was done is that was used to acquire Russian company was introduced at the level of the acquired company. And in international practice, how it is done, we will see on the next slide. But international practice, this type of structuring, which is not uncommon for M&A transactions, is called debt push down. And again, it's not contrary to tax law to make such restructurings, but the Russian practice seems to have taken routes where these transactions with this debt push down solutions are recharacterized, requalified for tax purposes. And we will see, on this slide, we are going to see what happens. There was a bank which provided loans to a Cypriot company, which was ultimately lent to a Russian company, White Square LLC, Russian OO, that's acquired from another Cypriot company, acquired a Russian subsidiary. So borrowed money was used to acquire Russian company by another Russian company. Well, the Cypriot intermediary in the loan structure was not really necessary, and these days probably you're not going to see it because it was a Russian bank. But it doesn't matter if the bank provided the loan directly, the outcome was the same, would have been the same. And yeah, the main problem of this M&A transaction is that obviously loan needs to be repaid, bank interest should be paid, but the company which acquired the subsidiary may not have any taxable profits. It have to obviously repay interest, but it is not able to deduct it. Most likely because it doesn't carry out taxable operating activities. It may be a pure holding company, and yeah, so there is a disconnect, as you can see on the picture. There is a disconnect. The Russian company that's acquired the subsidiary has all interest expense, while the operating company, which pays profits tax, is not able to deduct this interest against its operating profit. And the solution which was implemented in this case was to merge the two Russian companies, which resulted in one single company, which became both the borrower and the operating entity, which generated profits. And the disconnect ended, and interest expense started to be deductible against operating profits, which was kind of fair in a sense, because obviously the loan related to the acquisition of business, but the Russian tax authorities denied interest expense and also negative foreign exchange differences on the loan in the post-merger, post-acquisition structure, and yeah, they imputed on interest which was actually paid, they imputed withholding tax. Not only they denied the deduction of interest expense and negative foreign exchange differences, but they also yeah, recharacterized interest into dividends and applied withholding tax rates at a rate of 5%, which is not as bad as it could have been. 15% could have been used, but the tax authorities agreed kind of to apply the reduced withholding tax rate of 5%. Well, yeah, unfortunately for the taxpayer, the decision was the court decision. The courts of all three instances ruled in favor of the tax authorities. Could have been done differently. Well, we can speculate. Obviously, yeah, you know, in this case, we can speculate what can be done so that the problem does not arise. So we see here a company that borrowed funds and the operating company that generated profits. In order to introduce loan at the level of the operating company, there could be an agreement with the bank. And again, it depends on particular situation, but we can imagine that if the bank at some point in time provided loan to the subsidiary which was acquired, and then the subsidiary could have found basis to pay some of its ongoing profits, and again, it could be dividends, for example, on current profits, and distribute them to the parent company. Then the parent company would have an opportunity to repay the loan and settle some of the obligations to the bank. Again, if it's not done, you know, too bluntly, and if it's if there are corresponding business reasons and there are, well, you know, good grounds to set up structure like this or implement changes to the structure like this, at some point in time and gradually, the loan to the operating company could be increased so that more and more deduction is introduced at the level of the operating company, and instead of merging the two entities, they gradually repay the initial loan, so that ultimately, after some period of time, maybe a long period of time, say a few years, the interest kind of migrates, you know, is introduced at the level of the subsidiary. Again, it's not ideal, it's not immediate as it is with the merger, but something that can obviously be considered. Again, not tax-free, not risk-free, but can be better than just bluntly merging the companies and facing the claim, the deposition claim. Okay, and the third trend is claims and challenges in financing structures. And here we have a few cases. One is where there is a company that's a separate company in this case, but there are domestic, similar domestic cases, lent funds to a Russian company, which was controlled by the same person. So these are related companies: the Russian borrower and the Cypriot lender. The loan was in US dollars, issued in 2008 at an interest rate of 10%, and over the time, over the years, the amount of the loan, its currency, its repayment terms had been changing. Interest was never paid. The loan principal was partially repaid, and there were obviously interest expense on interest for the Russian borrower, and there were negative foreign exchange differences because initially the loan was in US dollars. So the Russian borrower, despite not repaying the loan, or only partially repaying the principal of the loan, but not repaying interest, accumulated and incurred expenses in connection to this loan. And there were, over the years, there have been trends in Russian case law where long and constantly loans which were constantly prolonged and rarely repaid or not repaid at all were recharacterized into investment transactions, or they were deemed to be of investment nature by the Russian tax authorities, and they try from time to time to deny interest expense, as in this case and also is in this case foreign exchange differences. But this case resulted favorably for the taxpayer. I think one of the reasons why it happened was that partially the loan was repaid over the period of time. And yeah, this demonstrates that attention should be paid to repayment terms, and if the loan is constantly prolonged, especially these days when it is difficult to pay funds abroad from Russia, and obviously there are instances where Russian companies, Russian borrowers are not able to fulfill their obligations in intra-group loans. Okay, as this case demonstrates, it is risky. There are factors that can be brought to the tax authorities to defend the deduction, and yeah, the more factors you have, for example, at least some repayments, the better. Yeah, as in this case, it helped. Another example where we have, again, this is a domestic structure, but it's nonetheless applicable to cross-border situations, similar cross-border situations. We have a parent company here, which has a Russian subsidiary. The parent company owns more than 50% in the subsidiary, and it provided loan to the subsidiary at some point in time. But shortly after the loan was provided, the parent company decided to waive the loan, and it was basically forgiven. And the Russian subsidiary, the subsidiary, the borrower, had to write off its obligations, which basically, in accounting terms, resulted in income for the subsidiary. And this income, the Russian tax authorities claimed that this income should have been subject to tax in Russia, despite there is a commonly used and very popular, I would say, exemption to write off loans between the related parties, between the parent company which provided the loan initially, and if the parent company owns more than 50% in the subsidiary, then even the tax authorities, even the Ministry of Finance over the years confirms that such loan waivers, such loan forgivenesses could be subject to the exemption provided by the tax codes. And the exemption basically says that funds that are transferred from the parent company to the subsidiary free of charge, or so to say, gratuitous financing. That's I think the formal translation of the Russian term, is subject to exemption. But in this case, and yeah, last year the Ministry of Finance changed its opinion on these situations, on this structure on loan forgiveness, and this is the first case where no, it's not the case. The first case where loan forgiveness was challenged and the exemption was challenged by the tax authorities, but this is the case where the first instance court ruled out in favor of the tax authorities, so kind of supported the claim, and it didn't help. The taxpayer couldn't prove that the exemption was available, even with a reference to positive clarifications, positive letters from the Ministry of Finance. And I think legally, from just pure legalistic point of view, there are grounds to say that loan forgiveness is not free of charge transfer of goods, because indeed, and the tax authorities, they kind of took this line of arguments. The initial transaction, the initial loan was not free of charge, and loan forgiveness is a separate transaction, which is not covered by the exemption. I think this is the main, in essence, this is the main problem with loan forgiveness here. And the old positive clarifications from the Ministry of Finance, they do not really, they kind of mostly pay attention to the substance of the transaction, but not to the form. In substance, obviously, one can say that it was initially intended to provide the funds free of charge, or as was the opinion of the courts of appeal, it was possible to argue, and the court decided in favor. The next instance court decided in favor of the taxpayer. It was possible to argue that the loan waiver represents the initial free of charge transfer of money to the subsidiary. So okay, this case is currently developing. Most likely we'll see the next instance, the cassation court. But so far so good. So let's wait and see. Hopefully this this positive outcome prevails, and yeah, is going to be confirmed. We'll see. But already it's clear that loan forgivenesses are not risk-free, unfortunately. Okay, and a few other cases relating to financing structures before we move on. One case where there were interest-free loans by a Russian company, despite this company had borrowed funds from other related parties and incurred interest expense. So we see instances where interest-free or low interest rate loans are provided from funds funds borrowed at a high interest rate, and the difference is challenged. The tax authorities, they believe, and I think they have grounds, that if company can provide interest-free loans, then it's not then the deduction of interest expense on borrowed funds is not justified. And this case demonstrates that it's indeed it can even be supported by courts, as in this case, and not only interest expenses is challenged, but also negative foreign exchange differences. Next case, we have imported goods, and again non-arm's length transaction where technical intermediary was deemed to be was deemed to be subject to the withholding tax on the difference between the actual price and the market price of goods. Again, this case demonstrates that even transactions where no withholding tax is formally due can be recharacterized into passive transactions. In this instance, where price was not arm's length. Okay, what are the practical implications from the case law which we have just looked at? About reduced withholding tax rates to dividends, it's better to structure investments into Russian assets directly, so that treaty benefits apply and reduced withholding tax rates for dividends are available. Because, as I said, in most cases, it is necessary to fulfill either investment requirements or participation requirements, or both, which are difficult, or if not impossible, to be fulfilled by indirect holding companies. Next, we see more and more cases where Russian withholding tax on cross-border transactions is due, even if no actual payment is made. Examples includes conversion of retained earnings into capital, novation of loan agreements, and sometimes transactions which are not subject to withholding tax are recharacterized into passive transactions. Again, examples are acquisition of goods at not arm's length, and sometimes in acquisition price there is a portion that relates to income that relates to which is income subject to withholding tax. Examples are interests, maybe royalties if it's I don't know, if it's equipment with software, for example. So attention should be paid to those cross-border instances. And in financing structures, it's important to keep in mind implications of not serving intra-group loans and novation of that. Okay, we are now moving on to introduction of withholding tax on services, which is another key development last year in Russia. Here on the slides, basically the change is very simple. Withholding tax introduced on intra-group services and work that are provided by non-Russian companies to their Russian again related parties, which is key. So if Russian company pays for services or work to a foreign related party, then now starting this year, this payment is subject to withholding tax. Again, example is very simple. If we have two companies, Russian and a non-Russian company, and the former pays services to the latter, then if they are related, then withholding tax applies, and the withholding tax rate due is 15%. Okay. But is it inevitable? Is it always that withholding tax should apply? And the answer is no. It depends on the situation. And usually tax treaties provide for exemption of services as long as they are not attributable to a permanent establishment in Russia. Okay, so if there is a treaty in place, it's not suspended, and in most cases, under Article 7 of the treaty, which is called business profits, and here's a quote from the Model Convention, which basically says, I will highlight this wording. That profits of an enterprise of a contracting state shall only be taxable in that state, unless the enterprise carries on business in the other contracting state. So this simple wording basically says that if a company in one country generates income from profits, business profits in another country, then unless there is a permanent establishment to which this income is attributable, there should be no withholding tax. These services or this business income should only be subject to in the country where the income recipient is located. Which again means if there is a treaty in place, then most likely profits services are not going to be subject to withholding tax. Obviously, it's in this context it's important that suspended tax treaties do not allow to reduce or apply withholding tax exemption on services, which is unfortunate, but it is what it is. Again, needs to be seen. In some treaties, there may be instances where services are not exempt or not covered by. Some services may not be covered by the treaty or may not be subject to exemption. Notable example is that Russian tax treaty with India, they have a technical service parts of technical services that are subject to withholding tax, most likely introduced by the Indian side, but it has mirror implications for Russian sourced income. And if last year and before, when services were not subject to withholding tax, to apply the exemption, nothing was basically needed. We just need to make sure that this is a genuine service and its price is not inflated. It's at arm's length. But now to apply treaty benefits or exemption for services, it will be necessary to obtain tax resident certificates and beneficial ownership confirmation, which is set of documents necessary to apply treaty provisions. So now not to withhold tax on services will require additional efforts. And if nothing works, and for one reason or another, withholding tax and due on services, it needs to be seen if withholding tax can be credited in the place where the service provider is located. And we will see at a couple of examples in this context. If a Russian company this year pays, for example, management services to a company in the United Arab Emirates, which is not uncommon in these days, and since services are going to be subject to withholding tax, and if the companies are related, which is also an important condition, then payment should be made net of 15% withholding tax. So withholding tax applies, but it can be seen if withholding tax credits against the new corporate income tax, corporate tax in the United Arab Emirates can be reduced. This tax can be reduced in the United Arab Emirates by the withholding tax, and it looks like it should be possible. Here is a quote from Article 47 of the law introducing the corporate income, the corporate tax in the United Arab Emirates, and basically it says that corporate tax can be reduced by the amount of foreign tax credits for the relevant tax periods, which seems to suggest that there are grounds even a tax treaty is not necessary. Again, situations are different in different countries, but in the United Arab Emirates, the tax credit seems to be based on domestic law. Even a double tax treaty is not required. Okay, so this is one example which can be done. What can be done to reduce tax inefficiencies where services are subject to withholding tax in Russia. Another example is instead of crediting against, or in addition to crediting withholding tax against local corporate tax, if the foreign company is also CFC for the Russian owner, the rules, and I quoted here the Russian tax code, where it says how the tax on CFC income should be calculated, and the rules are that income tax, personal income tax obligation can be reduced by the tax that the CFC pays, both in the country where it is located and also in source at source in other countries, including Russia. So the Russian tax on services in this particular structure can be credited not only against local income tax, but also against the CFC liability for the Russian owner. Obviously, if the Russian shareholder is a Russian tax resident and has to pay personal income tax on the CFC income, which is, by the way, may not be the case. For example, if this CFC passes subject to tax test. If the CFC owner receives income which is subject to withholding tax at a rate of 15%, chances are that this CFC's effective tax rate is going to be 15%, obviously, in this case. And in this case, this CFC can also qualify for the exemption, for the CFC exemption in Russia based on the effective tax rate, which may not be as efficient as if it didn't pass this subject to tax test, simply because if it does, then well, it's not immediately leading to additional tax obligations, but when dividends are distributed, then they are going to be subject to tax. And a calculation, a case can be made that company that distributes dividends out of profits which are included into CFC income, they are going to be exempt, and the structure can maybe even more efficient compared to the situation where the effective tax rate exemption is claimed. This is a complicated discussion. We're not going to get into it, but just to remember that CFC rules are complex and sometimes may even be counterintuitive, as in this case. Yeah, okay, but let's move on. We need to talk about deemed dividends in transactions which are not arm's length. And yeah, basically what happens is changes to the transfer pricing rules were introduced last year. They're effective starting this year. And here is a quote. Yeah, I will not read it, but it essentially says that if transfer pricing adjustment is made, then not only this means that transfer pricing adjustment leads to additional tax obligations on the Russian side. For example, if income is increased or if expenses are reduced based on transfer pricing adjustments in non-arm's length transactions, but also this income associated with the transfer pricing adjustment is deemed to be dividends for tax purposes and should be subject to withholding tax in accordance with respective provisions of the tax code, depending on the other party. If it's individual, it's going to be personal income tax implications. If it's entity, if it's an entity, a company, then it's going to be profits tax implications. And in both cases, withholding tax can be due, and the tax rates is the same for personal income tax and corporate income tax. It's going to be 15%. Again, it's only in cross-border transactions and for related parties, obviously, because transfer pricing adjustments, it kind of assumes that the parties are related. But this is not uncommon in other countries. Sometimes it's called secondary transfer pricing adjustment. Sometimes it is called constructive dividends, as the name as a name, this term is used in Kazakhstan, for example, and we will touch upon this a bit later. But yeah, this is what it is. This is what it is. So not only non-arm's length transactions may lead to additional local tax for the Russian local company, but also may lead to withholding tax on the difference, on the adjustment. Few things to note in this context. First of all, transfer pricing adjustments, they require special transfer pricing audit, which is not easy. It's not that a local tax inspectorate can carry out a transfer pricing audit. No, it is required. The central federal tax service needs to be involved. So yes, it's likely that transfer pricing adjustments will only affect, obviously they will affect businesses that are subject to transfer pricing audits and are closely looked after by the central federal tax service. Now there is a technical argument whether every transfer pricing adjustments leads to income of the foreign party. Let's not go into much detail here, but I doubt that the wording of the new wording of the imputed dividends rule works for all instances. For example, if the Russian company sells goods to its foreign, let's say, parent or related company, then the question arises if there is any income that this foreign company receives as a result of the transaction or non-arm's length transaction or the results of transfer pricing adjustments. It doesn't seem to be the case because the adjustments will lead to increase of income in Russia, but the expense on the foreign party, on the foreign side, will arise. And the same, it's not income that the foreign company receives when acquiring goods from Russia, it's non-arm's length expense, reduced expense. So yeah, the point here, the wording is not ideal. It remains to be seen if in some cases even transfer pricing adjustments are not going to lead to imputed dividends. And yeah, the obvious question is whether tax treaty benefits can apply. Again, dividends, as we saw from one of the cases, dividends require participation, and it's difficult to apply reduced withholding tax rates to dividends if the related party is not the direct parent company of the Russian party, which became subject to the transfer pricing adjustment. But okay, this is an open question. I think we'll need to wait and see. And obviously, yeah, in some cases, reduced withholding tax rate can be claimed. Okay, let's move on. The next section, the next part is on updated blacklist of countries. And last year, not only Russian double tax treaties were suspended, but also the Ministry of Finance, even earlier, even before that, introduced new countries to the Russian blacklist. Let's discuss what implications are. First of all, the Ministry of Finance introduced this offshore zones list back in 2007, and it was mainly used for dividends participation exemption. But later it was extended to other areas, and now it is used for many tax exemptions. And reduced tax rates are preconditioned by absence of the party in the blacklist in the country which is blacklisted. And examples of exemptions includes free of charge transfer of assets, which we already mentioned before, capital gains exemption for shares, the so-called 5-year exemption, transfer pricing consequences, as well as CFC rules, and even state subsidies. They were subject to, they were regulated by this, with a reference to this offshore zones list by the ministry, developed by the Ministry of Finance. So in June last year, the ministry issued a new version of this list, and 49 new countries were added. Not surprisingly, all the EU states, as well as the United States, Switzerland, Singapore, Japan. Well, basically, it mirrors, the additions mostly mirror the list of countries with which double tax treaties had been suspended as well. Okay. So then the situation developed, and the ministry clarified that the new version of the list applies only starting next year, well, this year now, 2024, which was not obvious from the beginning. For example, the treaties were suspended immediately after the decree in August was issued, but the ministry decided, but not immediately, not in June. It wasn't until November the 1st when the ministry issued its clarification, but the clarification was positive. It provided some additional certainty for the taxpayers last year. And then in December, a law was introduced that allowed use of a special list for some exemptions, and this special list is still in progress. It's currently draft special list is being considered. And is still pending. It's going to be introduced, but it hasn't happened yet. Yeah, but the good news is that special list for certain exemptions is almost identical to the old list, which doesn't include the 49 new countries, which means that despite the blacklist has extended, it still applies to some transactions, some situations, some tax incentives, but doesn't apply to others, which is again good news. Well, some exemptions, they are subject to the new and extended blacklist, and the list includes the 5-year exemption for capital gains, reduced withholding tax on dividends reduced withholding tax of 10% for dividends, royalties, and interest for so-called international holding companies, which are companies re-domiciled into special economic zones, special administrative regions in Russia. And the new and broad list also applies to transfer pricing purposes and transactions that are deemed controlled after thresholds after certain threshold is exceeded, which is unfortunate. For example, transactions with European countries, they became controlled based on this updated and expanded blacklist starting this year. Okay, but there are incentives which will not be affected by the old and expanded blacklists until the end of 2026, and only starting from 2027 the broad list is going to apply. But before that, the special list is going to be used, which is, as I said, much narrower than the new list. And these exemptions include exemption for active holding and supporting companies for CFC purposes, CFC profits adjustments for companies that were subject to sanctions and entities and owners of such companies. And most importantly, I think the free of charge transfer of assets exemption, which again I mentioned a few times already, and the 0% rate to dividends received by Russian companies and international holding companies from abroad, from foreign subsidiaries. Okay, I think the last 2 points are most common. So the exemption for free of charge transfer and the exemption for dividends received from abroad by Russian companies are going to be applied on the basis of the temporary and shortened special list, which is good news. Obviously, provided that this list remains the same and is adopted as it is currently drafted. Okay, the sixth and last section in the Russian part is tax developments affecting personal assets and structures, and I think we should be mindful of time, but I hope we will manage to cover all 15 topics in time. In time. Let's see. Briefly, 3 developments affecting personal structures. I would say those are material gain tax exemption is no longer available. So it was during 2021 and 2023 the exemption was available, but this exemption period is now over. Then fines for non-submission of financial statements along with CFC notifications are not going to be prolonged, and these fines start to apply. And the third development is that it is likely that the special exemption for assets received from a CFC will be extended. Let's talk about those, and let's consider just a few examples. And the first and second examples, they relate to the material gain exemption, and it's somewhat counterintuitive, this rule that if in certain cases, if for example the shareholder of the company receives loan from this company, but the loan interest is not high enough, then or if it's a zero interest-free loan, then income can be imputed to the shareholder as if it received it, but obviously it doesn't happen. In reality, the shareholder doesn't pay enough interest, doesn't bear enough interest expense, and this is the reason for the adjustment for imputation or recognition of income for the shareholder, income for personal income tax purposes, and it applies both to Russian tax residents and non-resident individuals who receive such loans. And yeah, last year and a couple of years before, the exemption allowed interest-free loans to shareholders because no material gain was applicable. But starting this year, such structures needs to be taken care of, and at least 2/3 of the Russian key rates of the key rate established by Russian central bank for ruble loans should be used, or 9% for foreign currency loans should be used, unless or if not, then the difference is going to be subject to personal income tax. So yeah, this is one instance. Another instance where material gain can arise is where a contribution is made again by a shareholder to either its subsidiary or, for example, to unitary investment fund, but the contribution of assets is made in exchange for shares or other securities, in which case, again, if there is accumulated capital gain on the assets which are contributed, then the difference between the market value, the current market value, and the initial cost basis of the assets which were contributed can be subject to personal income tax as material gain. And the reason is that it is assumed that the shareholder receives securities which value is higher than the cost basis of assets which were contributed in exchange for the securities, and this becomes a basis for the material gain charge. Yeah, again, yeah, this is to be mindful of. The good news is, for example, that if contribution is made to a limited liability company, a Russian OOO, then it is not going to be subject to these rules. At least material gain is associated with acquisition of shares or other securities, but not interests or participatory interests in a Russian in a limited liability company where no shares are present. Okay. Next development affecting personal structures is fines in connection with CFC reporting, and here again, for a couple of years, CFC owners enjoyed exemption from fines on non-submission of financial statements and audit reports along with CFC notification. But this exemption, this non-application of fines, has not been prolonged, and which means that this time when CFC notification is filed, which is going to be due by the 2nd of May this year for previous year, along with financial statements for 2022, then fines will apply. Again, practically, it's not always possible to obtain these days audit reports and financial statements from, for example, Cypriot providers, but the situation somehow should be addressed. And again, open question remains what can be done. For example, instead of financial statements, so-called Chapter 25 CFC-based calculation can be used, in which case financial statements for CFC purposes are replaced by, well, registers with calculation of tax base. It's more onerous. It's very uncommon to use something else than financial statements, but if not financial statements are available, this is the alternative. Again, each situation is different. And finally, tax exemption for assets received from a CFC. This is the exemption which was available to Russian tax residents for a couple of years, 2022 and 2023, and it's likely that it's going to be prolonged to 2024, which allows to basically receive assets free of charge and without paying income tax from foreign subsidiaries of Russian shareholders. Yeah, the conditions are more or less the same, and yeah, it can be considered to use it. And in the restructuring projects, we see this exemption being used. Okay, so to conclude, and what to do based on what we discussed concerning personal structures. Material gain. This year, it resumes, it starts to apply again after a couple of 3 years of break. Needs to be taken into account when structuring of financing of shareholders and restructuring of assets where shareholders are involved personally into transactions. Next, since penalties for non-submission of documents along with the CFC notification return, it needs to be taken care of, and filing needs to be prepared by the 2nd of May this year for 2023 tax return and CFC notifications. Yeah, and it can be considered to use exemption on transfer of assets from foreign subsidiaries to Russian shareholders using the exemption, which is likely to be reintroduced this year. Okay, so we finished with the Russian parts and moving on to the section where we discuss changes in Kazakhstan. And there will be three developments which are worth looking at. And the first one is the 3% deductibility limit on inter-group services, which was introduced at the end of 2022 and lasted almost a year until December 2023. So what happens shortly before 2023? The rule was introduced that if a company in Kazakhstan pays services to related party outside of Kazakhstan, then and there is a long list of services which are subject to this rule, these services altogether combined can be deducted only within the limits of 3% of taxable income of the company which pays for these services, which affected a lot of international businesses in Kazakhstan, because obviously headquarters, foreign headquarters, they usually provide services to their subsidiaries, and it's very common to pay substantial management fees or consulting fees or service fees to the headquarters, and all these types of services they were covered and they were affected. And moreover, the taxable income arguably only includes net income, which is subject to corporate income tax in Kazakhstan, which is not income as such, it's net income or profits, which made these limits even more strict, because 3% of profits can even be zero if the company is loss-making. Okay, so what happens in December last year, and it was speculated among the business community that starting I think the beginning of last year, that this rule was going to be cancelled or revisited. So what happens is that this rule only started to apply to service providers which are registered in the states with preferential taxation. So if the company that provides services is in a country which is blacklisted by Kazakhstan, then it's going to be subject to the limitation. If not, then intra-group services are not subject to the 3% limits, and this change was made retroactively, which is good news. And again, the blacklist in Kazakhstan is broad, but it mostly includes offshore countries. One notable, maybe exception is Hong Kong, which is not necessarily an offshore country, but it is in the list. But for example, European countries, they're not blacklisted. Okay, what does it mean? If payment for services from Kazakhstan is made to a related party in a blacklisted country, then this structure is still inefficient. Not only it is inefficient because of the 3% limits, but also because of withholding tax on services, and even increased withholding tax on services for income paid to blacklisted countries. The good news is that the changes were introduced retroactively, as I said, from the beginning when these limits started to apply starting last year. And for some companies, it may even mean that they didn't deduct enough intra-group services, and they may revisit their tax returns and refunds, or reduce their tax obligations for 2023. Okay, so this is one good development. The next one is cross-border case law. It's interesting to consider what case law developments we saw last year in Kazakhstan. And again, three trends here. One is requalification of service fees into royalties. Second is requalification of transactions into dividends, and denial of the so-called 3-year exemption in this case for dividends, but we'll see it also may affect structures where capital gains are realized from sale of assets in Kazakhstan. So the first case, recharacterization of service fees into royalties, and this is a widely quoted product case where the Supreme Court overturns the decisions of lower instance courts, which decided that an entity in Kazakhstan paid to an Italian related party services for various based on various grounds, for IT support, for sales support, for technical support, procurement, management, logistics, etc. And the tax authorities and later courts of the first and appeal instances characterized these services as royalties, and which should be subject to the withholding tax rate of at least 10%. And the reality in Kazakhstan is that royalties are not exempt. There is no tax treaty which provides withholding tax rate to royalties which is lower than 10%. So the domestic rate is 15%. It can be reduced to 10%, but no exemption is granted by any tax treaties, which is why, since services can be exempt, which is why the distinction is really important. It makes a difference between exemption and 10% withholding tax rate. Okay, so the Supreme Court, as I said, overturned the decisions of the previous instant courts and concluded and basically separated, distinguished between services and royalties, and explicitly stated that services, they, for example, usually involve employees. Services usually provided upon request. There can be timesheets may be made to calculate costs. They can be provided remotely, and when the service is provided, then it is in one way or another accepted by the recipient. And there are results such as reports, decisions, etc. While royalties involve some registered intangible, usually royalties do not involve staff, do not involve people, and payments are fixed or depends on the profitability of the business. So this distinction is then started to be followed by in other cases, and practice started to change after this decision was announced, and we see more and more cases where previous court rulings are either cancelled or returned to the decisions returned to initial courts. So, for example, in this case, there was a Russian company which claims refunds for withholding tax for services or for services which were deemed or characterized as royalties by the company in Kazakhstan which paid for the services, and the tax inspectorate denied the refunds and even charged additional withholding tax. And despite the Russian company disputed the decision, initially the courts ruled in favor of the tax authorities, but the Supreme Court decided to repeal these decisions and ruled in favor of the company. And in another case, which is similar, but where the decision was returned to the first instance with the comments that, first of all, there needs to be a distinction needs to be made between some part of services of IT services which are genuine services and some parts of the remuneration which can still be qualified as royalties. And this is kind of good comment from the Supreme Court. Not as good was that the Supreme Court said that the 10% withholding tax rate needs to be the grounds for this application needs to be revisited. And the practice in Kazakhstan, the case law in Kazakhstan and tax audits practice is such that usually reduced withholding tax rates are not applied if the withholding tax is charged. So unlike in Russia, where we see reduced withholding tax rates applied by the tax authorities when they charge additional withholding tax, it's unlikely, it's unusual, it's rarely the case in Kazakhstan. Yeah, and this is the example where the Supreme Court asked to revisit the grounds to apply the reduced withholding tax rate, and it is likely that instead of 10%, 15% will be charged to the parts of the service which was not genuine service but had grounds to be qualified as royalties. Next trend, imputed dividends, and here an interesting case where a Kazakhstan company which borrowed funds from the bank and asked, or well, the parent company, which is located in Switzerland, provided a guarantee or pledged shares in its Kazakhstan subsidiary, and the remuneration was paid by the subsidiary for the pledge of shares, which is, I think, fair because the parent company took risks and. In an unflanked situation in the markets, in a non-related party situation, pledge or some other form of guarantee can be treated as service or can only be granted if some compensation, some remuneration is paid, which was done in this related party transaction. But the tax authorities decided that these payments, which was, well, strictly speaking, service, represent dividend income for the shares or from the shares of the Kazakhstan subsidiary, and the fee, the service fee, should be subject to withholding tax and 15%. And it's interesting that the decision was not based on so-called constructive dividends. And here is a quote from the tax codes where the term, the constructive dividends term, is defined, which is basically the difference between the market price and the actual price, and the difference is positive if the price is above the markets and the payment is made to a foreign company, or again is negative if or the difference between the market price and the actual price is treated as constructive or imputed dividends, where the price paid by the foreign related party is lower than an arm's length price. Well, in one way or another, economically, I think it's clear when hidden distribution of dividends or imputed dividend distribution takes place, and this rule demonstrates that in Kazakhstan, what we now see in Russia, this imputed dividends or secondary transfer pricing adjustment have been in place for some time already. But interestingly enough, in the case which I've just described, it was not applied. For some reason, the tax authorities did not prove that the price for the service was not an arm's length, and they do not really referred to the constructive dividends definition, which is a pity, because I think if the taxpayer could have proved that the service was at arm's length, which most likely was the case, or it could have been the case, then no dividends, no non-arm's length income was transferred to the parent company. But yeah, it is what it is. I suppose the case or the position of the tax authorities could have been more sophisticated, but it didn't prevent the tax authorities from winning this case in court. Another case where dividends were imputed was where the subsidiary in Kazakhstan transferred or converted its retained earnings into capital, and in Russia we saw in the Mir Business Bank case, we saw that such conversion led to imputation of dividends and taxation of dividends, and the court decided in favor of the company. Despite there are some developments in the Supreme Court, we'll see how it unfolds. But in this case, from the very beginning, the court was in favor of the taxpayer, and the taxpayer failed. The tax authorities failed to prove or failed to substantiate that the conversion of retained earnings into capital was actually dividends received by the foreign parent company. Okay, so yeah, in this case, although we see that such conversions or conversion of retained earnings into capital can be risky and can lead to tax challenges, the court sided with the taxpayer. And finally, the 3-year exemption. We see the case last year, or even earlier. But we see the case where the Dutch company acquired a subsidiary in Kazakhstan in 2017, and shortly after the acquisition, distribution of dividends was made, and until 2023, there was a rule, and this situation took place before 2023. There was a rule that the 3-year periods when the 3-year periods of ownership allows not to withhold dividends, withholding tax on distribution of dividends from subsidiaries in Kazakhstan to other to countries abroad. The two exceptions are were basically where the parent company was in a blacklisted country, or where the company in Kazakhstan was a subsoil user. And in this instance, I think there were different reasons for the tax authorities successfully challenging the application of the 3-year exemption. And yeah, one of them was that it took only a year or maybe slightly more for the parent company to own the subsidiary before the distribution was made. And despite the taxpayer argued that there was a restructuring which led to the change of the parent company, but the law itself says clearly that there should be reorganization which doesn't interrupt the 3-year period. But in this case, the parent company was not reorganized. It was liquidated after the old parent company was liquidated after the sale. So legal ownership change took place, which disallowed, which prevented from the application of the 3-year exemption. And there were other reasons for the claim. I suppose 2 other reasons were that there was a permanent establishment of the parent company in Kazakhstan, and in some period of time in the past, the subsidiary was a subsoil user. So all these arguments taken together led to the tax authorities winning the case to dispute the exemption for dividends, which I think is a fair decision. And yeah, the bottom line on the lessons learned here is that first of all, sale is not reorganization for the 3-year tax exemption. And despite the 3-year exemption was abolished last year, well, the exemption was abolished, but there is still reduced withholding tax rate for the companies that are owned for 3 years or more. And yeah, there is 3-year exemption for capital gains, which is still in place. This is why this ruling, despite the exemption is not longer available, is still useful. And the lesson is that first of all, yeah, reorganization is not the same as sale. Permanent establishment of the parent company may lead to tax claims, and yeah, subsoil users may not enjoy the exemption, the 3-year exemption. So what are the implications? 4 implications for international structures. First of all, the risk of reclassification of services into royalties for the withholding tax purposes have reduced, which is good news. But there are risks of recharacterization of payments to foreign shareholders into dividends, which is unfortunate, and yeah, should be taken into account. Next implication is that conversion of retained earnings into capital is not dividends. The court ruling was positive where the tax authorities tried to charge withholding tax in connection with conversion of retained earnings into dividends, into capital. And finally, sale of shares does not equal reorganization, and presence of a permanent establishment is a reason to deny withholding tax benefits. Okay, so this is the last section for Kazakhstan, and we'll briefly talk about exemptions for participants of Astana International Financial Center. And the good news is that these exemptions remained in place. Last year, many participants, many business in business communities were also concerned that the tax benefits some tax benefits may be cancelled, but it didn't happen. So what we have is what participants to AIFC are used to, is exemption for corporate income tax and withholding tax on income in form of dividends, interest, and capital gains from sale of shares in subsidiary registered with Astana International Financial Center. There are also income tax and VAT exemptions for certain types of activities and services to other participants to the Astana International Financial Center. And finally, there are individual tax exemptions. So they are all intact, which is good news. And Astana Hub is another place in Kazakhstan, another special economic zone, so to say, a special tax regime. And we look through the exemptions that are provided by this regime, and mostly they remain unchanged, which includes exemptions for profits from corporate income tax, exemptions for VAT, which are valid until 2028. Important exemption is for VAT, reverse charge VAT, when services are purchased from non-residents. And it is especially important, this exemption, because services which are provided by the participants to Astana Hub, they are not subject to VAT, in which case, if VAT was charged or applied, reverse charge VAT, if it was applied, then it would have been lost because there is no output VAT turnover for participants. But luckily, the exemption is still available, and it's going to be available until at least 2028, as the law says. Yeah, there are personal income tax exemption for residents, employees, exemption on capital gains, and there is exemption for income for certain types of services acquired from abroad. The bad news, unfortunately, is that exemption for royalties paid to non-residents from withholding tax ceased to apply. It's initially, from the very beginning, it was supposed to last until the end of 2023, which already passed. Yeah, it's unfortunate because, as I said, and as is well known, royalties paid from Kazakhstan, they are going to be subject to withholding tax, even where treaty applies at a rate of at least 10%. Yeah, the 5% withholding tax rate on dividends remains, and the exemption of expenses for salaries of foreign workers from social benefits is also intact. Last but not least here is restructuring practice, and we see more and more cases where companies decide to move to the Astana International Financial Center. And one example is Polymetal, which is a company that's announced publicly that it is going to redomicile from Cyprus to, or from Jersey. Yeah, in this case it was Jersey to Kazakhstan, to the Astana International Financial Center. And another example is fixed price. Here from Cyprus, the company declared that the holding company in Cyprus decided to redomicile into Kazakhstan, into the Astana International Financial Center. Okay, so this is it about Kazakhstan. Let's move on to United Arab Emirates, and we have a couple of things to address here, and also a couple of questions which we were asked, and yeah, we'll deal with them as well. So as is well known, the tax reform is ongoing in the United Arab Emirates, and starting this year, most companies are going to be subject to corporate tax. At least corporate tax applies to most companies at a rate of 9%. Again, the rules are that any financial year after the 1st of June last year, for companies in the United Arab Emirates, is going to be the year when corporate tax starts to apply. But if financial year coincides is the same as calendar year, then yeah, the 1st of January is the starting point. The 1st of January this year is the starting point. Still, the exemption, the 0% rate, is still available, but it's available for companies in free trade zones, subject to certain conditions. And the conditions turned out to be quite substantial and diverse, and let's list them all and go into some detail. First of all, yeah, the company should, to enjoy the 0% corporate tax rates, the company should be in a free trade zone. It should receive so-called qualifying income, which includes income from qualifying activities, and there is a long list which changed, and we're going to talk about this in a minute. So it should receive income from so-called qualifying activities. It can receive income from other residents of free zones, except for so-called excluded income, and there is a list as well. Or it can receive, to qualify, it can receive income from so-called qualifying intellectual property, and this is something new. And basically, we have changes, and we're going to discuss changes in three respects here. Let me highlight. One is income from qualifying activities, and the list changed the list of qualifying activities changed in October last year. And qualifying intellectual property is something new. Before late last year, qualifying intellectual property was considered excluded activity, which disallowed IP companies, for example, to apply the 0% corporate tax rate, which changed, and we're going to talk about this in a minute. Yeah, not only these conditions should be fulfilled, the non-qualifying income should not exceed a certain threshold, namely 5% of total income, or 5 million dirhams, whatever is lower. And yeah, there are other conditions to be fulfilled for qualifying residents to be able to apply the 0% corporate tax rate, such as transfer pricing rules and documentation, substance requirements, and a few others. Yeah, so the list is extensive, but the rates, the exemption, the 0% corporate tax rate is still available. Let's look at the new list of qualifying activities. And here, most importantly, we see trading of qualifying commodities, because the initial list didn't include this item, which meant that's only item L, the one is here, distribution of goods or materials in or from a designated zone. And the list of designated zone didn't include some popular locations for trading companies, for example, DMCC, Dubai Multi-Commodity Center, which was unfortunate because many traders have been located, have been for years located there. But in November or late October last year, the list was updated, changed, and the trading of qualifying commodities was included, which allowed many trading companies to enjoy the 0% rates, for example, if they are located in this DMCC free trade zone. Yeah, so this is the new list. Let's look at it from the perspective of companies or functional entities that can be used or established in the United Arab Emirates, so that the overall tax efficiency of the structure is improved. For example, again, trading companies, they can rely on two types of qualifying activities and be subject to the 0% corporate tax rate, provided that other conditions are met. What else? Financing companies. The financing companies may qualify for the treasury and financing services provided to related parties, for example, or management companies can apply the headquarters services to related parties exemption or type of activity. All these are examples of entities and companies that can be used in international structures and with 0% corporate tax rates. Finally, investment companies. They can rely on the holding of shares and other securities for investment purposes. And not only this, the rapid participation exemption conditions and rules in the United Arab Emirates, which also allows to exempt income from investments, but this specific investment is also useful. This particular list of functional entities does not include IP companies, and yeah, the list of qualifying activities does not include intellectual property, but because it was a separate type of qualifying income from qualifying intellectual property. And here is a quote from the decision where, well, the term of qualifying property was defined. I'm not going to quote it, but the definition is not surprising. Software, for example, and patents were considered to be qualifying intellectual property, while marketing intellectual property assets such as trademarks are specifically excluded. And this is in other countries. For example, IP box regimes, they tend to follow the same logic. Patents and software are covered, while trademarks are not covered. But in addition to owning the rights intellectual property, it's important to fulfill other requirements or to make sure that the expenses of the company are correct or proper expenses. And again, there is a formula. We'll not go into detail here and now. Maybe it's a subject for a separate discussion. But yeah, not surprisingly, not every structure, even if qualifying intellectual property is owned in the United Arab Emirates, not every situation is covered or is going to produce the 0% rate. The amount of qualifying income is determined based on a specific formula. And again, the basic principle is where there are good expenses and bad expenses, and the more good expenses the company has, the better. And the formula brings the company close to the 0% effective tax rate. But bad expenses include, for example, outsourcing of developments, IP developments to a related party, and this is bad expense. It can only be 30% of good expenses to make sure that the formula works properly and doesn't prevent the company from using the 0% rate, or doesn't increase the rates to a higher rate. Yeah, good expenses they include costs, personnel costs, and development of intellectual property outsourced to unrelated parties. Okay, so here I would like to answer a couple of questions which we received before the event. The first question relating to the United Arab Emirates is as follows. What is the best corporate structure for an entity in Dubai selling both services and products? Does it require two separate companies? Well, let's think about this. It depends on obviously on the types of services and products, as well as your objectives. For example, if both services and products fall under the category of qualifying activities, qualifying income, then yeah, if income from these assets, from these activities is good income, falls under qualifying income definition. In this case, there is no harm in combining. I think there's no harm in combining, at least from tax perspective, and to enjoy the 0% corporate tax rates. There is no harm in combining these two activities, both selling of services and products, in one entity, because as long as both activities are so-called qualifying activities, and it will depend on the types of activities, obviously, if they fall under the list of qualifying activities, then the company as a whole will qualify for the 0% rate. If one of these activities is not qualifying activities, then I would say that separating bads and goods activities into different companies will provide a benefit, because as long as the activity is let's remember that the company may only receive bad income, so to say, within a certain threshold. If the company receives too much income from non-qualifying activities, then it breaks one of the rules, one of the conditions for the 0% corporate rates, which is 5% of income or less can only be made from non-qualifying activities, and can only be non-qualifying income. So it's more precisely, to be more precise. And if this threshold is exceeded, then the whole company's income is going to be subject to the full 9% tax rates. So the bottom line here is that separating the activities into two categories, entities, makes sense if one of them is qualifying activity, one type of income is good income, which can benefit from the 0% corporate tax, and the other one does not qualify for the 0% rate. This is how I would answer this question. There may be other reasons, but in the tax area, from the tax perspective, I think this distinction makes sense. Again, depends on the particular activities. The next question: is foreign exchange income taxed in the United Arab Emirates? Yeah, I briefly looked before the event. I briefly looked into the federal law, and yeah, basically the short answer is most likely yes, because my understanding is that corporate tax is paid based on profits which are determined based on accounting, and as long as foreign exchange is reflected in P&L, in the accounting, in the books of the company, then it's going to be captured by included into corporate tax base. Two exceptions which came to my mind were first of all, there is explicit exemption for gains and losses, foreign exchange gains and losses, which are accumulated or generated in connection with participating interest, so-called, which means if there are investments, shares in subsidiaries, for example, which generate foreign exchange differences, but these investments they qualify for the participation exemption, then this exemption extends to foreign exchange gains or losses. This is my understanding, which means that if this happens, if foreign exchange is connected directly to participating interest, so-called, to investments which are subject to participation exemption, then they are also ignored for tax purposes. And another example is where foreign exchange differences are there is a rule that allows choosing whether to include foreign exchange differences on realized or unrealized basis, but it looks like it's only applicable to situations where assets and liabilities, they are accounted for based on their fair market value, which is, strictly speaking, doesn't seem to be the case for any asset and liability. And in most cases, the assets and liabilities, they are not, so to say, mark to market. They are not related based on the fair market value. But again, this is an accounting question. My guess is that in most cases, there is no choice. And again, if even there is a choice to account for foreign exchange differences based on accrual or realized basis, it's only temporary difference. It's only deferral that you can achieve to not to include foreign exchange differences into income and consequently into tax base for corporate tax purposes. So this is my answer. Again, this is a broad and preliminary answer, but this is the direction of thoughts that I decided to share. And again, it makes sense to look closely at the specific case that you are dealing with, whether the differences relate to a participation, for example, in your station. Okay, and the second part of the United Arab Emirates section is where we consider examples of, and we see more and more instances where companies are redomiciled into the United Arab Emirates. Again, this is a legal question, and it's interesting that there are public announcements of some companies that decided to redomicile. This particular company, Global Trans, they chose Abu Dhabi Global Markets, the free trade zone in the United Arab Emirates, to redomicile their Cypriot company. In this respect, there are three practical considerations in connection with restructurings involving the United Arab Emirates, which I would like to share. One is, it is obviously important to decide where to redomicile a company if you decide to redomicile into the United Arab Emirates. And it looks like lawyers say, it's a legal question, but lawyers say that redomiciliation is possible to a few free trade zones, notably Dubai International Financial Center and Abu Dhabi Global Markets. The latter is evidenced by the previous example. There are a few others, DMCC included, for example. It is important what happens in the country from where redomiciliation takes place and exit taxes may apply. And finally, I would argue that redomiciliation, although it's popular and we see more and more cases these days where companies redomicile from one country to another, it's not necessary. It's not always necessary. Sometimes the same result can be achieved by other measures, can be achieved by sale, for example, or liquidation of a company in one country and distribution of assets or transfer of assets to another company or to another country even. So I would say that although redomiciliation is an interesting tool, it's not always it's not necessarily the ideal tool for each and every purpose. Other restructuring scenarios can be considered. Okay, so we are going to move on to the European Union, and then I will, we should have time to discuss a couple of other topics, Hong Kong and global tax reform. So two things here. First is Russia in the blacklist of European countries. And yeah, last February, the EU announced that Russia is the European Union basically updated its list of non-cooperative states and included Russia as well as British Virgin Islands into the list, which means depending on a particular country that one or more of the following measures will apply. Withholding tax may apply on some payments from the European country to the blacklisted country. Expenses may not be deductible. Credits of withheld taxes may be denied, and CFC rules may apply, or denial of CFC benefits may take place. And let's consider, just based from my practical experience, a couple of instances where this change, the inclusion of Russia into the European Union blacklist plays a role. Let's look at the example with a Cypriot company with structure that we see here. One instance where Russian company distributes dividends through a Cypriot holding company all the way up to the ultimate shareholder, who happens to be a Russian tax resident and a Russian citizen. And sometimes the already mentioned look-through approach for dividends is used. And in this case, with difficulties with payments from Russia, it's very common to even bypass intermediary holding companies in European states and pay dividends directly. It is possible, and it has even some not only practical but also tax advantages. Okay, so in this situation, as we with Cypriot's team, with Cypriot experts, found out, it looks like payments to individuals are not going to be affected, which is why similar structures with Cypriot holding companies, although they tend to be replaced by other countries, but where they're still in place, they can still be efficient, because it looks like Cyprus does not impose withholding tax even despite payments to the blacklisted country, where the recipient of income is an individual rather than a legal entity. In other instances, for example, like on the slides, there is a loan from Russia to Cyprus, and then Cyprus pays interest. This interest may be subject to withholding tax, and is likely to be subject because, again, Russia is blacklisted. Cyprus has a direct reference to the European blacklist, and yeah, double tax treaty between Russia and Cyprus, even though Cyprus still seem to respect and apply it, does not provide for the exemption, and withholding tax of 15% may apply in Cyprus. The open question: where does the withholding tax starts to apply? And I think there is still not much clarity from the Cypriot side, but most expect that despite the blacklist was updated in February last year, it's only 2024 when withholding tax will actually start to apply. At least there is hope. But okay. And in the Netherlands, the blacklist, in the Netherlands situation is more predictable, because the Netherlands they update their own blacklists, and they even expand it compared to the European Union's list. And at the end of December, the Netherlands updated their list and included Russia as well as a few other states into it, while the United Arab Emirates were excluded. So yeah, and the list applies starting 2024. So in the Netherlands, the implications, including withholding tax, start to apply this year. Okay, and to continue and finish the discussion around the European Union, let's talk about abolition or phasing out of the so-called non-habitual resident regime in Portugal, which we worked with on a few projects, and so we see that this regime was popular among businessmen who owned various assets and received various income, and moved to Portugal. It provided for certain tax benefits, including exemption for dividends, sometimes exemption for capital gains, and the flat tax rate for income of so-called highly skilled personnel from highly skilled activities. So last year, this NHR regime stopped to apply, but it was replaced by a new version of this regime, NHR 2.0, with more stringent conditions. But this change is kind of a reason to look at other beneficial tax regimes for individuals in the European Union and in other countries. And this table on the slide it's quite it's quite diverse and detailed. I think we are not going to look at each and every country. I will name a few. For example, Cyprus, and we see here Cyprus is on the top of the list, and the first few columns, they represent exemption for dividends, income, and capital gains in Cyprus under the so-called non-domicile regime for individuals. The residency conditions are not very strict. In some situations, provided some other conditions are met, it is sufficient to stay in Cyprus for only 60 days. Unfortunately, the treaty with Russia is suspended, which for businessmen with Russian assets makes this regime or this location less beneficial as than others, or than it used to be before. But yeah, some beneficial regimes require lump sum payments, but Cyprus does not. And yeah, we see here that Cyprus is very competitive compared to other countries. I will mention a few others. I think for businessmen with Russian assets, especially attractive or interesting regimes in countries which are not considered non-friendly. And here is Israel. It's here, and we see that the tax treaty between Israel and Russia is still in force. It is also Hong Kong, which is the second row on the table. The treaty is in force. The conditions for the tax residency conditions seem to be more strict. It's necessary to stay in Hong Kong for more than 180 days, but otherwise, it's a beneficial, favorable regime. And the third one is United Arab Emirates. It's here. Again, the only disadvantage here is that it's not a regime as such. There is no individual income tax in United Arab Emirates. And recently, there was a public announcement, kind of commitments, or announcement was made that the United Arab Emirates is not going to introduce individual income tax. The only one of the few disadvantages is that there is no double tax treaty yet between Russia and United Arab Emirates, but otherwise it looks pretty attractive for businessmen. For businessmen with various assets, including Russian ones. Okay, so to conclude, despite the NHR regime in Portugal was abolished, or replaced by a more stringent regime, there are many other preferential tax regimes for individual, providing tax benefits for individuals in Europe and other countries. As I said, Hong Kong, the United Arab Emirates, and Israel look interesting for owners of Russian assets. And sometimes, special tax regimes for individuals are being criticized, and UK non-domicile rules are a good example. And we are likely to see changes and developments in this regards in the near future. And finally, in many cases, use of the regime require careful planning and preliminary planning. For example, it's important that in some cases, in Portugal, it was important that during the 10 years preceding the regime application, the taxpayer, the individual, was not tax resident in Portugal. So it's not that one can move to a country, wait or live for a couple of years, become residents, and then only start thinking about the preferential regime. It's better done in advance. But yeah, this is it. This is it, and I'm going in a few seconds. I'm going to be replaced by a colleague of mine, Ksenia Shugalko, and she will address two remaining items. One is Hong Kong and tax developments there, and the second and last is international tax reform. So stay tuned. In a few seconds, Ksenia, you will see her.
Victor, thank you. Good day, everyone. Let me introduce myself. My name is Ksenia Shugalko, and I'm Senior Tax Manager in KEPT and working with Victor on international tax projects. In my part of presentation, we will review recent tax changes in Hong Kong and look at the current status of implementation of Pillar 2 model rules into domestic law of different countries. And first of all, we will start with Hong Kong. This country is often used by multinational companies in international structuring, and that's why Hong Kong, to Hong Kong, it should be given special attention. The first topic that we will cover is an overview of the new tax regime, namely foreign sourced income exemption regime. This regime became effective in last year in Hong Kong and covered 4 types of passive income, which is foreign sourced. Especially, there are dividends, interest, capital gains from the sale of equity, and royalty. Under the FSAE regime, this foreign sourced income received in Hong Kong should be deemed should be sourced from Hong Kong and liable to Hong Kong profit tax. This foreign sourced passive income will be considered as received in Hong Kong when the income is remitted to Hong Kong, the income is used to satisfy any debt incurred in respect of business carried out in Hong Kong, and the income is used to buy movable property, and the property is brought into Hong Kong. As you may already know, the FSAE regime was introduced as a measure to get off Hong Kong from the EU grey list of non-cooperative jurisdictions for tax purposes. However, despite the changes introduced, Hong Kong remains on the grey list of the European Union in 2023. As further requested by the European Union, Hong Kong revised its FSAE regime to extend the scope of foreign source disposal gain to cover all types of assets. As a result of legislative amendments, the expanded FSAE regime came into force on the 1st January 2024. Now the revised FSAE regime is broader and covers foreign source gains from disposal of IP assets and gain from the sale of other assets, which may include all types of movable and immovable property. Other provisions of FSAE regime remain unchanged, except for introduction of new intra-group transfer relief. And we will talk about this relief a little bit later. In brief, the main concept of FSAE regime is that this regime applies to multinational group carrying on business in Hong Kong and which fail to meet the exception requirements. As you can see from the table on the next slide, the exceptions requirements are applied depending on the particular type of income. And if I look at the foreign source dividends, it can be excluded from taxation in Hong Kong when the economic substance requirement or participation requirement are satisfied. Regarding foreign sourced IP income, only the nexus exemption is available. Also, the revised FSAE regime introduced in this year an intra-group transfer relief to defer charging of tax on specified foreign sourced income from disposal of property between related parties. And this relief is subject to specified anti-abuse rules. That is all for an overview of the FSAE regime. So let's move on to the development of the current practice of application of this regime in Hong Kong. There is a positive trend that our Inland Revenue Department publish on its website the advanced ruling cases on the application of the FSIU regime. Such rulings may cover 5 years of assessment. The first ruling presented on the slide deal with economic substance requirement for foreign source dividend. This ruling are favorable, and the R&D stated in this ruling that the applicant they fulfill the requirement of economic substance requirement, and therefore the foreign source dividend should not be taxed in Hong Kong. But the last one ruling, which was recently published by the R&D, is a different one, and it contains other exceptions. In brief, if you look at the background of this situation, the applicant is a holding company incorporated in Hong Kong and carrying on business in Hong Kong. It has 2 subsidiaries located in foreign jurisdiction F, company F1 and company F2. Company F1 is engaged in manufacturing and maintain a factory in Hong Kong and perform activity in special industrial zone. The corporate income tax rate of the jurisdiction F is 20%, but company F1 benefits from 50% exemption from corporate tax. Company F1 paid its corporate income tax for 2022. In the specified arrangement in the ruling, Company F1 plans to distribute dividend to its holding company in 2023 out of its retaining earnings as of the 31 of December 2022. The dividend will be paid to bank account of holding company in jurisdiction X. Then the funds will be transmitted to company F for further investment purposes into the share capital of this company. In the arrangement, it is explicitly stated that the dividend will not be used to satisfy any debt incurred in respect of the business carried out by the holding company in Hong Kong. And what was the conclusion of the R&D in this case? The R&D stated that the dividend shall not be regarded as an income received in Hong Kong, and therefore should not be liable to profit tax in Hong Kong. And even if the dividend is regarded as received in Hong Kong, it shall not be taxed since the conditions of participation exemption requirement are met. In order to fulfill the conditions of the participation exemption, it is important that the underlying profit of the dividend, which means the profit of company F1, should be subject to qualifying similar tax in the jurisdiction F. And this condition is also met in the considered case. And to conclude, the ruling is favorable for the taxpayer, and that is a very good case. But from our side, we would like to point out that it is unclear on what basis the ruling stated that the dividend will not be used to satisfy any debt incurred in the connection of activity of holding company in Hong Kong. In addition, the ruling did not explicitly state whether the applicant was a pure equity investment company, but if it is, the dividend used to pay for the subscription of shares in company F2 could be regarded as satisfying the debt in respect of the investment activity of holding company in Hong Kong, and as such, the dividend would be deemed as received in Hong Kong and would be chargeable to profit tax unless the participation exemption requirement or economic substance requirement are satisfied. Of course, it is a certainly positive practice that R&D published such ruling cases on its website for the reference of taxpayers. However, given that the ruling is granted based on the specific facts of an applicant, and not all these facts can be disclosed in a published case, taxpayers should not strictly follow the conclusions provided in this published rulings, and should make a decision based on the comprehensive analysis of its own situation. since the FSAE rules contain many criteria and conditions, in order to be on the safe side, taxpayers can file an application with R&D and confirm tax consequences of foreign-sourced income in its own ruling. So we also assist our clients in obtaining such advanced tax rulings from the R&D and support them in the through the whole application process. So that is all that I will tell you about FSAE, and let's move on to the final part of my presentation at International Tax Reform Pillar 2. In this part, I will briefly update you on the current status of the implementation of Pillar 2 model rules. Starting 2024, many countries have already implemented Pillar 2 rules into its domestic law, including EU countries, the United Kingdom, Canada, South Korea, and other countries. Let me remind you that Pillar 2 rules introduce a global minimum tax for the multinational groups with consolidated revenue of 750 million euros or more. This measure is designed to prevent profit shifting to low tax jurisdictions. Pillar 2 model rules will have a far-reaching effect on the taxation of multinational enterprises, especially those with an effective tax rate below 15%. In such cases, such multinational enterprises would require to pay a top-up tax in respective jurisdictions. Also, it is important to note that the implementation of Pillar 2 model rules is proceeding very rapidly, and more countries are joining to this global tax reform. For example, Hong Kong has launched a public consultation to discuss the implementation of Pillar 2 measures, and the proposed rules are set to apply from 2025. Thailand is in the process of drafting the relevant domestic law, while Malaysia has already enacted the relevant law, which is expected to enter into force in 2025. Also, the United Arab Emirates announced that they're going to launch a public consultation of Pillar 2 implementation this year. As for Russia, Pillar 2 rules have not been implemented yet, but Russian groups with international presence may be affected by these rules if they are implemented into domestic law or for jurisdictions where the group subsidiaries operate. To summarize, Pillar 2 rules are very complex and contain many guidelines and clarifications. Although the first filing deadline of the respective reporting will be in June 2026, the multinational groups do not have much time to prepare to comply with filing requirements in advance. So that is all. Dear participants, I would like to thank you for your attention and give the floor back to Victor.
Okay. Well, that was the last topic, and we already run out of time, but we received a couple of questions, so I decided to reply to those, and then we will call it a day. The first question, Evgenia asks, is the list of qualified activities expected to broaden? Yeah, fair question. I don't know. I haven't heard any rumors about changes or expected, additions to the list of qualifying activities. So I don't know. The previous change was not significant, but it was obvious that trading companies were disadvantaged kind of unfairly. This is why it was kind of logical to expand it and add to trading of qualifying commodities. But yeah, nothing here. Hard to tell. Anastasia, a Russian company purchases IT services from an interdependent company that is a resident in Kazakhstan. Is there any obligation to pay withholding tax? The short answer is you should be able to avoid withholding tax if, apply the exemption, because it's Russia that pays income, in which case Russian treatment is important. And although this year withholding tax on services was introduced, still there is a double tax treaty which is still in place between Russia and Kazakhstan. And the double tax treaty, it should allow for exemption. I vaguely recall that there are special provisions in Article 7 of the treaty which need to be taken into account, but leaving it aside, I don't really remember if it has anything special concerning IT services. It may affect situations where there is a permanent establishment of company in Kazakhstan, and this is a normal situation. If the service provider carries out activities, provides services through a permanent establishments in the source country, in Russia in this case, then, well, yeah, this income can be taxable. And in Russia, it's going to be replaced. In Russia, the company which carries out activities through a permanent establishment should register a branch representative office and recognize its commercial activities and pay tax itself by reporting income through the permanent establishment, through the branch. And in which case, no withholding tax is going to apply either, but the income will be taxed by the service provider. But leaving it aside, if there is no permanent establishment, then I would expect that services should be able to qualify for Article 7 and not be subject to withholding tax. I would look at the article once again just to make sure that there is no special provision which affects such cases. But yeah, broadly speaking, tax treaty allowed to exempt services even subject to withholding tax based on domestic law in Russia starting this year. And yeah, we'll need to make sure that all the documents are in place, including tax residence certificate and confirmation of beneficial ownership, and that services do not contain other types of income such as royalties, which is not uncommon in IT world, in IT services. In which case, withholding tax on 10% applies, but it's a different story. It's not services; it's royalties that trigger withholding tax. And this is it. We only received 2 questions, and thank you very much for your attention. I always say that each situation is unique, and what we discussed should be applied carefully depending on your facts and circumstances. And what we do with my team is we advise clients to help them to maintain to keep their cross-border structures tax efficient. And I encourage you to get back to us if you have questions in relation to a particular situation, and we'll be more than happy to help. Having said that, I would like to thank you for your participation and for your questions. Thank you for your attention. It was a pleasure to be with you for more than 2.5 hours, and see you next time. Thank you.